All right, let's talk about something huge in spread betting. Managing your risk isn't just a nice idea, it's everything. Today, we're going to zero in on the one tool that's absolutely vital for this, the stop loss order. Let's jump right in. So, here's the question, right? The one that probably keeps a lot of traders up at night. You put on a trade, it's looking good, and then bam, the market just dives out of nowhere. How in the world do you protect yourself from those crazy, sudden swings? Well, the answer is right here. It's the stop loss order. Honestly, the best way to think about it is as your personal, preset ejection seat for a trade. It's a simple instruction you give your broker that says, hey, if things go south and the price hits this level, get me out. And the best part? It does it for you, so you don't have to be glued to your screen all day. Okay, so let's dig into this a little more. The real beauty of a stop loss is that it just yanks the emotion right out of a bad trade. You get to decide your absolute maximum loss when you're thinking clearly, not in the middle of a panic when the market's tumbling. It's kind of like your own personal financial circuit breaker. Now, here's where it gets really interesting. Stop loss isn't just one thing. Nope, it's not a one-size-fits-all kind of deal. You've actually got a few different flavors to choose from, and each one has its own pros and cons. So let's break them down. So this is the fundamental choice every trader has to make. First, you have the basic stop loss. It's free, which sounds awesome, right? But, and this is a big but, in a really volatile market, you can get something called slippage. That means your trade might close at a way worse price than you wanted. Ouch. On the other hand, a guaranteed stop is basically like buying insurance for your trade. You pay a little bit extra upfront, but you get total peace of mind that you will get out at the exact price you set, no matter how wild the market gets. But hold on, risk management isn't just about cutting your losses. It's also about protecting your profits. I mean, what happens when a trade is going great, and then it suddenly turns on you? Well, that's where this really clever tool comes in, the trailing stop loss. It's designed to let your winners run while protecting the gains you've already made. So how does this thing actually work? It's pretty cool. You just tell it, hey, stay 20 points behind the current price. As the market moves in your favor, that stop loss automatically crawls up behind it, always keeping that 20-point gap. What you're doing is building a rising floor under your profits. If the market suddenly turns and drops those 20 points, bam, the stop gets hit, the trade closes, and you've locked in your profits automatically. It's a fantastic way to take the guesswork out of taking gains. Okay, theory is one thing, but let's make this real. Seeing how a stop loss works with actual numbers is what really makes it all click. So let's run through a quick, super practical example of how you'd set one up. And you know what? Placing one of these is incredibly simple. When you go to open a trade, you'll just see a field for your stop loss. You decide on the price level where you'd have to admit, okay, I was wrong on this one. You punch it in, and the system shows you exactly what's at stake before you even click confirm. All right, let's put some real numbers on this. Let's imagine we're going long on a stock at 500 points, betting £10 per point. We decide our pain threshold, our line in the sand, is 20 points down. So we place our stop loss order at 480. Now with that all set up, what's our absolute maximum potential loss? £200. That's it. Just the 20-point risk multiplied by our £10 stake. And here's the powerful part. Before the trade even starts, we know the absolute most we can possibly lose. That's the magic of a stop loss. It turns a big, scary, unknown risk into a simple, known, and manageable number. Okay, so we know how they work, but what's the catch? What do these things actually cost? Because let's be honest, nothing's ever totally free. Understanding the price tag is absolutely critical. It really all comes down to a classic risk versus certainty scenario. The standard stop has no upfront fee, but you're paying with a different kind of currency, the hidden risk of slippage, which could make your loss bigger than you planned. The guaranteed stop is the exact opposite. You pay a clear upfront premium, and in return, what you're buying is pure, simple certainty. Your loss is capped, period. So this all brings us to the final decision, doesn't it? It's a choice every single trader has to make for themselves, on every trade. It's a fundamental battle between a potential unexpected loss and a small, definite cost. This quote really just nails it perfectly. When you pay that premium for a guaranteed stop, you're not just paying for a feature, you're paying a fixed price to completely wipe out a specific kind of risk from your trade. It is, for all intents and purposes, an insurance policy against a market meltdown. And that's really the question I want to leave you with. Which will you choose? Will you accept the risk of slippage to save a fee, or will you pay for absolute certainty? There is no single right answer for everyone. It all depends on your strategy and what you're trading. But just understanding that you have this choice, that's the first huge step to mastering your risk. Thanks for tuning in.